Hello and welcome back. You're watching Business Arena here on TVP World. I'm your host Alexandra Marchewicz and these are the latest business headlines. There was a lot to celebrate at the Warsaw Stock Exchange this Friday morning as it rang in its first IPO of 2025. Our reporter Konrad Gorliński was there to cover the event.
We are at the Warsaw Stock Exchange this Friday for the first IPO of the year. Medical diagnostics firm Diagnostyka offered over 16 million shares valued at over 400 million euro. The scalar reduction was over 94%, so unfortunately only 800,000 were left for retail investors. The shares hit the market at 9 a.m. with an initial price of 105 zloty, or about 25 euro per share. Well, the shares are doing well. They jumped over 30% in the first hour of trading. Well, the company Diagnostyka's CFO, Paweł Hitwa, told us about the long road to this moment and the tidal wave that was the pandemic.
It was a very hard process. However, a great fun because Diagnostyka is a business with a great business model and effective strategy, which we managed to communicate to the investors, and they welcomed us very well. And as we can see, we have a very good coverage of the book, and the interest of the investors is really above our expectations. We are already at the peak from the COVID revenues, and our forecasts, as forecasted by the market analysts, will be even higher in future years.
And this is also a very big day for the Warsaw Stock Exchange, valued at over €500 million. This is the highest valued IPO in Europe so far this year. WSC President Tomasz Bardziłowski tells us more.
We had a fantastic start to the year. Polish indices are one of the best in the world, and today we have a fantastic, amazing IPO and debut of Diagnostyka, the largest network of medical labs in Poland, and investors are extremely happy. We have amazing increase in the share price, so that's a great start and a good sign for other companies to think about Warsaw Stock Exchange as a source of raising capital.
So, we ended the first week of February with one of the Warsaw Exchange's largest IPOs. Let's hope we see more of these this year. I'm Konrad Gorliński, reporting for TVP World.
This weekend, Latvia, Lithuania and Estonia will disconnect from the Russian energy grid. The EU-backed move is a major step for the Baltic states in enhancing their energy security.
This weekend, the three Baltic states are set to cut one of their few remaining links to Russia.
We'll no longer be dependent on the aggressor state and will have full control over our own energy system.
Still part of the Soviet-era BRELL grid, along with Russia and Belarus, the Baltics will switch to the continental synchronous area with an aim to ensure a reliable frequency control needed for a stable and secure energy supply. But before the switch is concluded, they will have to operate independently for a brief period.
By 9 p.m., we will be disconnected from the Russian synchronous area and will operate as an island of the Baltic states. This island operation will last until Sunday afternoon, when the Baltic Sea electricity system will be connected to the continental European synchronous area.
The long-awaited switch cost some €1.6 billion. 3/4 of which was covered by the EU. While it comes 10 months ahead of the planned deadline, Ukraine and Turkey managed to achieve this feat 3 years ago. Experts say this delay was because of the scale of the project.
Main reason has been that our grid is built up in a way that is actually part of the former occupying state, Soviet Union. So to rebuild it from north to south, starting from Estonia, Latvia and Lithuania, we had to do some investments, and investments take time.
While consumers are not expected to feel any impact either in power supply or prices, authorities are prepared for potential Russian interference.
Readiness is high. As I also said, we have addressed the National Armed Forces, the Home Guard, to make sure that they are also present so that there's no possibility of some kind of hybrid threat undermining this whole process of disconnection.
Nevertheless, the switch is more of a symbolic event, because the Baltic countries ceased imports of Russian power back in 2022 due to major diversification efforts.
Estonia, Latvia and Lithuania are parting ways with the Soviet-era electricity grid, and stakes couldn't be higher. Will this ambitious move bolster energy security and economic resilience in the region already under geopolitical pressure? Join us after the break for the expert insights from Rokas Masulis on the bottom line, so don't go away. Polish consumers are warming up to Chinese cars. Only in January, the number of vehicles from Beijing registered in Poland spiked by 1,000% year-on-year. Now, experts say that Chinese rides offer decent quality for a moderate price, filling a vacuum left by Western producers.
They just keep on coming. In January 2025, around 2,000 Chinese cars were registered in Poland. That's 1/5 of the total number of PRC-produced cars registered in the country throughout the whole of 2024. According to Dariusz Palcerzyk from the Samar Automotive Research Company, the secret behind Chinese rides' growing popularity in Poland but also Europe is rooted in strategic errors made by European producers.
Some time ago, they made a strategic mistake by letting go of the cheaper cars segment.
Contributing to this decision were disruptions of global supply chains, think the COVID pandemic and the ongoing invasion of Ukraine.
All of this has pushed manufacturers to focus on the segments that are most profitable, that is, where margins are higher.
The majority of Chinese wheels registered in Poland run on petrol, and European Union tariffs have something to do with it. And it's not just that. Chinese car manufacturers have mastered the art of offering high-standard vehicles at affordable prices.
In the automotive market, prices do wonders, but the price is not the sole argument in favor of choosing a Chinese car. Amazing quality is another.
The invasion of Chinese cars on European roads has caught the attention of EU policymakers. The European People's Party has pushed for a revision of the greenhouse gas emission goals in order to preserve the competitiveness of European car makers.
First, we propose that we move away from penalizing those who are combustion engine car producers. Secondly, there should be a revision of the sale ban of such vehicles no later than this year.
In line with EU policies aimed at phasing out internal combustion engines, if the average CO2 emissions of a manufacturer's fleet exceed its specific target, in a given year, the manufacturer must pay for each of its new vehicles registered in that year an excess emissions premium of 95 euros per gram of CO2 per kilometer of target exceedance.
And that is all for our business news updates today. For more stories, check out tvpworld.com.